Ladies and gentlemen, thank you for tuning in to the Dylan Holy Experience midweek market recap. Specifically, it is 6:01 p.m. on the Pacific Coast, Pacific Standard Time, 9:01 p.m. Eastern Standard Time. Ladies and gentlemen, let me know if you can hear me loud and clear in the chat. Uno momento, por favor. It sounds like we are coming into you live. Just lovely in all 720p and 128 kilohertz for the microphone. So let's just jump straight into this midweek market recap. Stock futures rise on Wednesday evening. Stock futures ticked higher Wednesday evening. Futures tied to the Dow Jones Industrial Average added 41 points or 0.1%. S&P 500 futures gained 0.3%, and NASDAQ 100 futures jumped 0.6%. NASDAQ futures got a boost from NVIDIA, which rose more than 8% after hours on better than expected fourth quarter earnings and revenue. And we're going to be talking about that in a wee little bit. In regular trading, the Dow lost 84.5 points or 0.26%, while the S&P 500 fell 0.16%. Meanwhile, the NASDAQ composite rose 0.13%. The moves came after the Federal Reserve released the minutes of its most recent meeting, which concluded February 1st, showing that members of the central bank are resolved to keep fighting inflation with rate hikes. And in fact, let's just talk about these Fed minutes a little further. Inflation remained well above the Fed's 2% target, the minute said. That came with labor markets that remained very tight, contributing to continuing upward pressures on wages and prices. If we take a further look here, the Federal Reserve, after talking about how inflation stayed well above their 2% target, they did bump that 0.25% in about 2 weeks ago. So, this is about in line with what we were expecting. This brought the federal funds rate to 4.5 to 4.75%, as you all know. Participants noted that inflation data received over the past 3 months showed a welcome reduction in the monthly pace of price increases, but stressed that substantially more evidence of progress across a broader range of prices would be required to be confident that inflation was on a sustained downward path, the meeting minute said. And if we actually take a look here, we can actually take a look at the CPI numbers. And we broke this down a little bit last week, but if we just take a further look here, let's do the full breakdown for the inflation report. But yeah, inflation is still very much hitting us hard. I mean, dude, I went to a Thai place in my town. And, 2 years ago, I would be able to pay like $15 for a whole meal, and now it's like 18 or 19. So it is definitely hitting us harder than what they want to be saying it is, like that 6.4% range. It's definitely not 6.4%. It's definitely, I feel like dude, clearly here, food at home is 11.3% more expensive. Food away from home even, so eating out and stuff like that, 8.2%. So yeah, man, these price hikes, and I definitely think some of the price hikes are definitely corporations wanting to charge more. Like, how is it that food away from home is 8.2% according to the CPI, but the average price of Chipotle has risen by like 25%? In fact, we can actually take a look at these metrics that are literally Dylan Holy Experience exclusives. This is exclusively on @RealDylanHoly on Twitter. Of course, you know we're going to be doing a plug for this type of content. Come on, baby. Yeah, take a look over here. I'm always dude, there's some serious stuff going on that we're only talking about on Dylan Holy, on @RealDylanHoly on Twitter. But America spent more on eating out than groceries in 2022. American consumers spent nearly $90 billion on dining out in 2022, up 24% from last year. So yes, and inflation is due in some part of this, and it could be more people actually going out to eat, but it's also this is going off of a nominal value, so like how much money was actually spent on eating out and buying groceries. And I definitely think a part of this is due to corporations bumping prices higher than or faster than that 8.2% range that is being stated from CNBC with their CPI numbers and everything. But yeah, so it is crazy seeing that people spend more on eating out than groceries each year. But this is really not that much of an anomaly. I mean, like, it's going from 2019 into early 2020. It's about the same. It spiked it dropped during 2020. So people were going to grocery stores more than eating out. But yeah, I mean, stuff is just getting more expensive. And yes, it is starting to slow down. And I do think that the aggressive rate hikes from the Fed meeting minutes, it's definitely, I think the 75 basis point moves are probably behind us. Maybe a 0.5 percentage move. But I mean, even according to the Fed meeting minutes, a few members said they wanted a 0.5 point or 50 basis point move, but that would show even greater resolve to get inflation down. A basis point is equal to 0.01%. So, I mean, a few of them did show interest, but I think at this point it's just kind of about like tapering and doing small changes where like they are wanting to get us down to a soft landing, but I don't think that's gonna happen. If we take a look here, one of the Federal Reserve presidents, the president specifically of the St. Louis Federal Reserve, James Bullard, he said that they should go even higher. And they said that they were going higher to hit about a 5% effective federal funds rate or so, but they think that but Bullard thinks that the terminal rate should be around 5.375%, and man, that's going to be pretty gnarly. Like, I think this soft landing. Excuse me, one moment. Bullard, he said that it should go above 5%, and what? It's one thing about slowing down the actual markets and stuff like that, but I think an even bigger issue with raising these interest rates to like the highest they've been in like pretty much 30 years, to 5.375% terminal, man, the biggest thing that's going to get hit are debt-based assets and anything that is financed. And it's not just like debt-based assets in terms of like, oh, like there's going to be less people, originating mortgages, and it's there's going to be less people buying used cars or financing cars. But how about people who have financed their food? And Dylan, well, what do you mean by that? I'm talking about people who have credit cards. A few days ago, the New York Federal Reserve announced that credit card debt in America hit $990 billion in Q4 of 2022. And this is the highest that has ever been reported, just under $1 trillion. All the while this is happening, and dude, shout out Fred, bro. This is one of the greatest financial institutions instruments to be able to find just like straight up market data about interest rates. It's ran by the St. Louis Fed, but dude, it has everything. Now, one of the things that Fred has is commercial bank interest rates on credit card plans, meaning what is the interest rate that they're charging on credit cards right now? And if you take a look here in November of 2022, the average interest rate in America was 20.4%. Now, what that means is it's a 20.4% APR. And anyone who has a credit card knows that 20.4% is absurd. And these people are carrying balances. And now if we take a look, the average American household carries a balance in Q3 of 2022, and this is adjusted for inflation, of $9,200 in credit card debt. A minimum monthly payment at 20% APR or so comes out to a minimum of $245 a month. If we're taking a look at the actual of what is actually generated in just interest alone per year, annual percentage rate, if we do, 9,200 times 0.2, 20%, each year Americans are generating at near $2,000 in credit card interest alone. Now, let's extrapolate just the credit card interest number to an entire balance of $990 billion. That means America is generating nearly $200 billion in interest alone per year. Now, why am I talking about this? Why am I painting a picture right now? And what am I painting a picture of? Well, what I'm talking about here is these interest rates. If they're going to keep bumping them, the interest rates are going to go higher. And I think, people are already, nearly all of America is basically living paycheck to paycheck right now. If you're bumping the minimum payments up, because that's what happens. They bump the minimum payments up per month, so people have to pay more on their credit cards because it's a variable interest rate. It's not fixed like, say, an auto loan is. An auto loan, you have a fixed, I have a fixed $365 payment per month. That's fixed. So and I financed in July of 2021. At 4.99%. So that's fixed. My car payment has not been impacted by these rate hikes because it is a fixed interest rate. But for anything that is variable, this stuff's about to get crazy. In fact, and albeit these percentages of people that are actually defaulting on their loans are not as low as 2008. 2008 was insane for mortgages, auto loans, credit cards. We're nowhere near that right now. And that's the emphasis on right now, because we have never seen interest rates this high with this amount of debt before. And that's scary because this soft landing that everyone is talking about, this stuff is just starting to play out. Like these interest rate increases that happened last year, they're just starting to catch up to consumers and asset classes. So what's going to happen once the uber aggressive interest rates start coming in? And obviously, if we look at credit cards right now, they've skyrocketed. The interest rates have skyrocketed from 2020, from about an average of 16% to 20%. The credit card interest rates have jumped by 25% in a year. Not saying that they are at 25%, but from where they were, they have jumped 25%. Mortgage rates have doubled where they were 1 year ago. I mean, this is absolutely absurd. Absurd. Now, let's take a left turn over to earnings report land. We came out of a slew of earnings reports. We are definitely out of earnings season for the quarter, but we still have some companies doing some earnings reports. NVIDIA, their stock rose after a slight beat driven by AI chips. If we take a look at their earnings per share, they beat. So they actually earned 88 cents earnings per share versus the expectations of 81 cents. And they made $6.05 billion versus expectations of $6 billion. I'm not an NVIDIA owner, but anyone who is owning NVIDIA right now, I'm sure they're over the moon that NVIDIA has increased by a factor of over 8%. In after-hours trading, their data center revenue, which includes AI chips, increased 11% on an annual basis. And I'm not surprised. Everyone's going all in on AI now. You've got your ChatGPTs, you've got your Google Lambda, even though it's kind of falling apart. And speaking of Google, I guess we can kind of unpack this right now. Google, amid downsizing, corporate downsizing, is asking employees to share desks. The company's cloud unit has told employees that it will transition to a desk-sharing workspace in its 5 largest locations. Employees will alter days in which they are in the office, either Monday and Wednesday or Tuesday and Thursday. And internal documents cite slow return to office patterns and the need for, quote, real estate efficiency. So they're just trying to condense costs. Not surprising. I mean, dude, they're making money, but they are hemorrhaging money, and they are horribly overvalued still. I mean, their price earnings ratio, let's take a gander here. Their price earnings ratio is 20.12. So it's not overvalued compared to other tech companies, but it is overvalued compared to like a traditional like 8 to 12 price earnings ratio. And obviously people say like, oh, Boomer Dylan, 8 to 12 price earnings ratios are gone now from any company worth investing to. Go back to the 1890s when Benjamin Graham wrote The Intelligent Investor. But I don't know. I still kind of go off that stuff. I mean, Warren Buffett goes off of it, and he outperformed all of us since this downturn. But no, Google, it's an overvalued tech company. The tech bubble's popping, and they're needing to downsize, and this is a downsizing measure. Now, speaking of tech companies downsizing, if we take a look over at Coinbase, it did beat on revenue for its quarterly report. So it earned $629 million versus the $590 million analysts expected, but it lost $2.46 per share versus the earnings on versus their expected loss of $2.55. So it is still hemorrhaging money, but hey, at least it be on earnings. Coinbase's user base is also starting to shrink. The company said it had 8.3 million monthly transacting users, down from 8.5 billion the prior period, and analysts were expecting 8.22 million, according to the Street account. So its transaction volume fell 12%. So yeah, I mean, this is just an ongoing crypto winter kind of thing. Not surprising here. Bitcoin's coming back. I still dollar cost average into Bitcoin. I can't tell anyone else what to do because I'm not a financial advisor, and nor should you take financial advice from me for right now. Hint. But nothing right now. This is all just me riffing. I own Bitcoin. I'm not saying that you should buy Bitcoin, but I am continuing to buy Bitcoin, even though it's down right now. Even though it pumped, it's like just under. I have Bitcoin on my wrist. It's at 24,200. So me dollar cost averaging over a long period of time, I'm still in the money, and that's all I'm going to say about that. Amazon closed on its $3.9 billion deal to purchase primary care provider One Medical. The e-retailer agreed last year to acquire One Medical to deepen its presence in healthcare. Now, this isn't the only step that Amazon has been taking to move further into healthcare. They also debuted their RX Pass, so it adds generic prescription perks for Prime members, and you can get up to 50 generic medications used to treat common conditions. Now, someone asked me on Twitter, and I can actually bring this up because it was a very fair. Oh yeah, I guess that's a little spoiler. Meta is adding a paid verification badge for Facebook and Instagram, $11.99 per month on the web and $14.99 a month on iOS. And of course, Mark Zuckerberg looking like Mark Zuckerberg. Let's break down this Amazon stuff for a moment though, because someone on Twitter asked me about this. Also, once again, dude, come on, man, we just got to plug it. @RealDylanHoley on Twitter. I'm giving y'all dude, this entire feed, everything that I'm speaking to the millions about right now, the millions see it first on Twitter. There's no reason to not go follow. Anyway, also Bill Gates has acquired a $902 million stake in Heineken, faded globalist, even though he's not that big of a beer drinker. But let's talk about this Amazon move a little further. I do think it's specifically a strategic advantage on Amazon's part to get access to Prime members' medical information. I mean, dude, that is so profitable. Like, sorry, but people's medical information. They literally can't live without their medicine. So Amazon wants to get in on it, and they want to provide, the most convenient option for people to be able to get their medicine and their healthcare and everything. So is this probably going to be a profitable venture for them? Probably. Is it getting a little more dystopian? Also, yes. Intel has slashed its dividend by over 65% from 36.5 cents to 12.5 cents. This comes after weeks of the company announcing far-reaching compensation cuts. There are a lot of people who own Intel that only owned it exclusively for its dividend, and now that it's been cut 65%, I think a lot of people are going to be moving away from it. I know Dividend Data, who's a big old dividend investing YouTuber, he said he has sold 100% of his Intel stock. So, I mean, are they cutting down on their expenses and overhead? Yes. Is it not great for investors? Anyone who owns that company and was only holding them for dividends, probably. I never owned any Intel. But yeah, it's definitely down. And they are looking to rebuild their dividend back up, but it'll probably take a bit. It's the lowest it has been since it's the first dividend cut since 2000. Since 2000, it's been their first dividend cut in nearly 23 years. Its prior yield was 5.6%. Now it's 1.9%. So they are down horrendous right now. Speaking of being down horrendous, Norfolk Southern, who is responsible for the train derailing in East Palestine, and now the cleanup of the train derailing and its toxic waste that was spewed out in East Palestine, the CEO, Alan Shaw, believes that it's all good now. It's all safe. He's even been drinking the water. And yeah, man, this is not toxic water. This is Pride water. Let's make this abundantly clear. This water right here, do you see that rainbow? It can't be toxic. It's Pride water. It's delicious. It's just great stuff, man. Speaking of, I guess people could say the woke mind virus, probably, at least right now, the most radical man in America. Joe Biden announced that the United States is going to host the 75th anniversary of the NATO summit in 2024. And that's about where we're going to leave it for the midweek market recap. It was a little more condensed, but I know y'all are busy people with places to be. So thank you so much for watching. I guess we can get into our little plug area here. So youtube.com/@DylanHoley. That's where half of y'all are watching the midweek market recap right now. So for the half of you that are subscribed and watching, thank you for subscribing and also tuning in to the midweek market recap. The other half of y'all, I know you guys are watching over on twitch.tv/RealDMH, so be sure to give me a follow over there, and you'll know when I'm live, and you'll be watching it, and we'll all be having a grand old time. Lastly, of course, twitter.com/@RealDylanHoley. This is the move, man. We're always giving y'all breaking news on massive stuff happening in the financial markets. Exclusive breakdowns of what's going on in the world of credit and interest rates and consumer spending and big old macroeconomic stuff. And of course, key takeaways. Every single day the market is open, the Dylan Holey experience is open, and we give y'all the most important hand sought. We find this data ourselves, and we give you the information ourselves, and we compile it all into key takeaways every single market day. So once again, @RealDylanHoley on Twitter, youtube.com/@DylanHoley, twitch.tv/RealDMH. Thank you all so much for watching once again. I hope you all have a fantastic rest of your evening, and have a good one.